Okay, so let me know if you have any problems seeing the presentation. It should say Black Swans profiting from surprises. The coveted black swan concept, yeah. So let me provide a little context here as to I'm more or less borrowing the phrase black swan in this context anyway, in the trading context, from Nassim Taleb, who the who's a, I guess I would describe him as kind of a pop mathematician. But really interesting. He wrote the book. So for those of you who are looking for good book recommendations that aren't another rehash of some, RSI strategy or whatever, I'm being a little sarcastic, but if you're looking for some good books that are definitely thought provoking, he wrote two books that I think are excellent. One's a bestseller called Fooled by Randomness. And it's a lot of people, when I recommend that to traders, they go, "Wait, that's an anti-trader book." Well, it's not an anti-trader book. It's for a smart trader. There's a lot of very good concepts in there. And then there's another one that he just came out with recently called Black Swans. And so let me tell you what this is. This is an expression. It's been around for a long time. Black swans were for a while thought to not exist, and the idea is that they're extremely rare. So and dramatic. And in the market, that's a great analogy because there are things that happen in the market that are extremely rare and are very dramatic. So, for example, since November of last year, we've had several little black swan events that relative to the credit crisis that have made for some very big moves, big corrections in the market very quickly. Well, the whole idea behind looking for or preparing for is what I should say. Black swans is that it's not a technical formation. You're not really relying on any particular setup. What you're trying to do is anticipate that there are unknown unknowns that are likely to move the market big. We have no idea when they're going to happen or what they'll be, but history tells us that they will happen over and over again. We continue to kind of experience them. And let me go a little bit further. Oh, by the way, there was a question, and this is an interesting presentation for me. I mean, this is one of my favorite topics, as a matter of fact, is preparing for the real unknowns. But it's not an overly complicated topic. So if you have questions, feel free to ask. One of the questions, by the way, was: is there a place that I can get this presentation? Definitely. There's not a lot of slides in this particular presentation, but you can definitely get it. You can either email me, John at PFX Global, or you can go to my site, pfxglobal.com, and you can IM me there. But either one's fine, and I'll send it right out to you. Also, I should let you know that we do record these, and they'll be posted on the FX Street site and our site as well here shortly. So you can take a look at it in recording as well. Okay, so let me talk about that. I would really classify black swans as falling into two major categories. The first one would be a big and immediate surprise. So, for example, I used the credit crisis that we've been experiencing, political issues. I'm sure most of us can imagine what things like that could be. Rates, so surprise rate adjustments, stocks, collapse in the stock market, something like that. These are the kinds of things that we're looking at. And I use the example of the dollar CAD versus oil. So right now we have kind of this is an interesting political debate going on between some parties in the oil business saying that production is fine to meet demand, and speculators who are saying it is not fine and oil prices are going to go up and therefore they're driving the prices up in the market. And but is that a bubble? I don't know. And that's actually exactly the point. Is that is oil going to go to $200? Certainly could. Is it going to go back down to 80? Well, it definitely could. And one way or the other, it's because the market is getting to this extreme level. It seems likely that there's probably going to be an opportunity in the near term. It's just a question of when. So it's a matter of preparing for that unknown time frame, which I actually have a couple of examples, and I'll show you a very specific one on the dollar CAD that should be thought provoking. Okay, scenario number 2 is kind of what do you do with your long term? Is taking advantage of this stuff in the long term outlook. So this is not so much, Black Swan really kind of refers to the event, the unknown event. So specifically, a collapse in the oil market. So oil falling, $20 in a day or $15 in a day or something like that. But the other way to look at this is to kind of take in here. I'll give you a very specific example. So although I listed the Aussie dollar here as overvalued or undervalued, which is it? It's certainly gotten to an extreme, and there's a way for you to obviously take your longer term outlook and take advantage of that in the longer term, where you can avoid all the little whips and pivots and such in the middle of that move and apply a longer term outlook to the market. But a specific example would be, I hear endlessly traders saying that the U.S. dollar, is doomed. Doomed, they say. So there is no way it can be recovered. That we're going to see, $3 to the pound and $2.50 to the euro, and on down the list, and with a fairly reasonable, a fairly high level of confidence that is in fact definitely going to happen. Well, I say to that rather than debate the validity of that particular analysis, if you are that confident, there is a way to take advantage of that information in such a way that you don't have kind of the complexities of trying to buy an outright spot position on the euro dollar that you're trying to hold for the next 12 months or something like that, as you forecast the dollar going another 2,000, 3,000 pips or something. And I'm going to talk about that actually as we get into a couple of examples. And the reason why I included it in this case is that it in my mind, it really does qualify as something of a black swan, meaning that it's the unknown and it's dramatic. It's just a matter of the time frame is a little bit different. Instead of a very fast move, it's a slower one, but just as dramatic. So let me talk about a couple of things, just to cover, why is this that it's a popular strategy? You'll talk to traders, by the way, in other markets, including the Forex, about trading black swans, and to some extent, most of us are trading black swan ideas at some point or another. And a couple of reasons why it's such an effective strategy, by the way, is that, and this gets to actually a pretty critical point in my presentation. It has to do with options. Now, for spot Forex traders, this has not been really an opportunity that they could trade, but as of, over the last couple of years, there have been exchange traded options available, over-the-counter options being made available. So there's plenty of opportunity now for Forex spot traders to be able to use options. And the issue is that options are priced, certainly supply and demand is a function of how an option is priced. Also the underlying, whatever the euro dollar or whatever it is that's the underlying that the option is attached to is, clearly a major factor in options pricing. But it is well known, and you'll see options traders talk about this all the time, that longer term options and even to a certain extent short term options are actually mispriced, and we all know why. They cannot account for the dramatic event. They don't. You can't really account for the unquantifiable unknown. So. Rather than it would just be, I think it would be just as easy to be overpriced, but options typically are underpriced because of that, particularly in the long term, which gets to one of the topics that I was mentioning, that if you're looking at a dramatic move that happens sometime in the long term, well, options are the way to go. Now, let me pause here for just a second. There are. I'm bringing up a web browser here just to be able to show you the. This is my site, and if you haven't been here before, there's an education tab up here at the top. If you go there, there's a whole course. I bring this up actually because there's. I always get a lot of questions about options. Seem intriguing to people, but right now we have 4 courses up. We come out with these pretty regularly. Forex options down here on the bottom. So you are welcome to come. Everything's free. You don't have to register or anything. It's just advertiser supported. So come check it out. Forex options if you need a little help understanding what they are and how they work. It's a multi-lesson course on how to trade FX options and including a couple of strategies that I think are pretty interesting. Okay, so let's get back to the slide here. All right, so when you're trading black swans, that is one of the things that you're doing is you're taking advantage of that mispricing that for once is in your favor. You're welcome, trader. No problem. So for once, it's in your favor. That's it. That mispricing actually works for traders, and the further out you go, the better it is. Now, I do have to say, it is capital intensive. But the trade-off is that is number 3 here is that you do get big, but infrequent wins. But they tend to be big. The offset to that is, of course, it's that you have a lot of small but frequent losses. And I'll actually run through a specific example as to how does that. What do you mean by a small loss? How does that work and what causes that small loss? Now, overall, what we're really doing is we're a market neutral but pro volatility stand. So, I would say most of the time. So, probably the most common way to take advantage of this particular strategy is with straddles or strangles, where you're not taking a directional position, you're taking a neutral position. So, I'm going to talk about that here in just a second in a case study. What you're doing is, of course, you're trading long calls and puts, and they have some advantages. They have some very, very big benefits. Number one, they're limited risk. If you're long an option, you can't lose more than you've invested. Period. It's unlike a futures contract or a spot contract where you have unlimited risk on one side or the other. A long option position, you have absolutely fixed risk. It's limited to your purchase price. You get plenty of leverage. So and by the way, if you're wondering how leverage works in the options market, I actually have within that course that I showed you, there's a whole section on what does that mean? What does leverage really mean in the options market? And you have access to both sides of the market, obviously. So when you're trading calls, that means you're essentially trying to buy a security that is going to benefit if the market rises. And when you buy a put, you're buying a security that you are using to take advantage of the market when it goes down. Okay, so I'm not going to go into a ton of detail on the background of options because that's something that we've done before. There's actually some historical presentations on the site, on both sites actually, that you can refer to if you'd like. But for those of you who have any options experience, this isn't going to get overly complicated. All right, so I'm going to bring up my charts. Hang on just a minute. All right, and just let me know if you can't see my charts, okay? Now, wow, the market's moving already, huh? So, or I should say, it is still moving at this time in the morning. So we've got the dollar CAD here, and I've been stuck in a channel, kind of bumping up against the bottom side of this channel right now, around 9,800 or so. And if we move this line right up to our current market price, we can talk about specifically what's a way we could take advantage of some of this uncertainty. I think that right now the dollar CAD is a little bit torn. It's got pressure from just the North American economic slowdown in general on it, but then it also has of course, oil prices have been very favorable for the Canadian dollar, and that's somewhat supportive. So we've seen this back and forth, and we wind up in this situation where it becomes very uncertain. However, there are some things that we can do to take advantage of this because, I would suggest that there is the potential for a black swan. And what that means is that, let's say specifically that oil prices get into a situation where traders begin to kind of feedback on themselves, and it either goes nuts, the market either goes totally insane, and we get $150, or it gets into the short squeeze, or I guess a long squeeze, and we get this just pounding all the way down to, let's say, 80 or something like that. Now, you may argue how valid that particular analysis is, or not, or you may completely agree. But what we're really taking advantage of is just well, if anything, if something dramatic like that happens, then certainly we're going to get a big move on the dollar CAD. But even if it doesn't, the dollar CAD is likely to move somewhere. It's just a matter of how far and how quickly. So let's use a very specific example. I'm gonna enlarge my chart here just a little bit so I get out to this range here. I'm gonna put just a little tick mark out here on about 620. So I put that little tick mark out there just to show how far away about a month is. And I'm using that because I'm suggesting that, well, between here and then, the market is likely to move somewhere. So how could we take advantage of that? Is it going to bounce up off of support? Well, maybe. Or where is it going to go? Now, let's say that I was pricing this actually just before the presentation. The market was at 98.60. So I'm going to stick with that price. We're going to assume that the current price right now is 98.60. And at the time, so we're interested in buying a straddle. What that means is that we're buying both a call and a put. That seems somewhat counterintuitive because if you're both long, if you're both trying to take advantage of the upside as well as the downside, then doesn't it kind of net itself out like a straddle would in, or like a hedged position would in the spot market? No, it doesn't. In fact, it's kind of simultaneously hedged, but it still has unlimited upside as long as the market moves above a certain level. So the way that most options in the Forex are priced, by the way, is in pips. So in this case, if we were to buy a straddle right here at this price, it would cost us 238 pips. Sounds like a lot, right? So that's how expensive that particular position would be. And what that does is it buys us a call with a strike price of 98.60 and a put of a strike price of 98.60. So if the market falls, that put's going to start becoming much more valuable, which is about half the cost here. And if the market rises, that call is going to become much more valuable, which is, again, about half the cost here. So the other position will, of course, begin falling in value, but it can only fall a certain amount. So it has a fixed amount of losses that it can possibly accumulate, and then you start accumulating a net profitable position. And how do you figure out where you need to get to be profitable? Well, it's pretty easy. You just count 238 pips to the upside or 238 pips to the downside. As long as the market breaks above or below those two barriers, which we're going to draw here in a second, you're in a profitable position. So let's do that. Let's draw a couple of lines here. Okay, the first one we're going to have to go to about right about there. And the second one, we're going to draw right about almost off the chart, actually. Right about there. So those two barriers are 238 pips away from this midpoint. And what we're assuming is that the market is going to get to one of these levels by this time frame. So as you can see, because we're anticipating a pretty big move, what we're trying to take advantage of is an opportunity for one of these unknowns to really push the market in a big way. And these moves can occur very quickly, as we can see over the last couple of weeks. We had a move that was very, very fast. So it's one of these situations where you're trying to say, well, if this unknown event happens, which, if you're a trader doing this kind of analysis, you would assume, well, if it does happen, it's going to happen in the near term. Therefore, I'm just going to buy an option that gives me this much time. If I needed more time, I can extend that quite a bit, which we're going to talk about here in just a second. In fact, there's really there really isn't much of a limit. You can go out, a year, sometimes plus, or more than a year in time. It's just going to cost you more. So if you need more time, it's going to cost you more, but it gives you more time for the market to work itself out. Now, by the way, I have to make a comment here. One of the most common pieces of feedback that I get from folks as we're talking about a strategy like this is that they'll say, "Well, what if my analysis says that that in the short term at least, there's not going to be a black swan, that there is not going to be there's a very extremely low likelihood of something like this happening. This is way too. This is just a way too big of a. The market's going to definitely stay within that range." Well, you can actually sell these straddles as well and get paid to be the person who says, I don't think it's going to go outside of this range. So just food for thought. That's something that we talk about in the course as well, and you can check it out. All right, so let's shift gears just a little bit. I'm going to bring up the pound yen. I'm curious, anybody out there trading the pound yen these days? Or is it? It's a toughie. I know because if I know a lot of shorter term traders are, but longer term traders are having a tough time with it because it's so volatile to the downside, but has that juicy premium on rollover. So okay, so we got a couple of people trading the pound yen. I see a lot of people talking about it. That's for sure. And it's a great. I love this pair. It's a lot of fun to trade it. And because it's so volatile, it moves so much. So let's draw a little line where we are right now. In fact, just as I was pricing this, I was preparing some of the things I was going to say last night, and we were 200 pips, almost 200 pips away from where we are right now. So, that's exactly my point, is that this is a particularly volatile pair. The other thing about this pair is that, like anything crossed with the yen, it's not only sensitive to stocks, but it's sensitive to the credit crisis. And of course, what's one of the things that's going on right now? We have this weird investigation into a cover up, quote unquote, on some mispricing issues, or some misrating issues by Moody's. So how bad is that situation? If they did cover it up, how much more are they covering up that's going to come out in the investigation? That certainly has potential to be a black swan because traders are going to glom onto that piece of information. They're going to start freaking out. So if this actually turns out to be something that is, if that investigation into those bond ratings is turns out to be something much more serious than what's currently being reported, then that's going to be definitely something that could push the pound yen or really any yen cross. So I just got a question: cover up what? So no, great question, Boyke. Since I'm running a little bit tight on time, rather than explaining what's going on. Everybody's reporting on it, but we also have a video, today's video, the daily video on our site. You can go check it out, and I talked about exactly what is it that's going on, and one idea around taking advantage of it. So if you want to check that out, it's really an interesting story, and if it starts taking off, it could definitely take a life of its own and move the market in a big way. So here in this case, because the market is more volatile, buying a straddle is also going to be more expensive. So buying this about the same amount of time, so buying about a month's worth of time on the pound yen would cost about 587 pips. So will the market move almost 600 pips one direction or the other? I mean, that puts us up at about, let's see, well, about there and about there. So, so let me answer a couple of questions that have popped up. So, because I think we get the basic idea. The idea is, of course, that we're trying to leverage the unknown. We're going to be paying a very expensive price, 587, but our probability of having a loss is also fairly high. But having the probability of having small loss is very high, because the closer you get to either of these barriers, the smaller your losses are. In fact, these two barriers are break even. So the closer you get to them, so let's say that we fell short by 100 pips, then you only lose 100 pips and not what you invested. So where am I getting these prices? You can get these prices from two places. These are options prices. And right now I actually have my options trading platform open in front of my face, so I'm getting those prices from that as I'm doing this presentation. And I'm using, in this case, I'm using an over-the-counter options prices, so I'm working with a dealer. Now, however, you can also get these prices from the options exchanges or from an options broker. So for exchange traded options. So here I'll show you exactly what I'm talking about. So some of you may actually recognize this particular dealer platform, but these are options in a chain sheet that I'm showing you right now, and what's the bid, what's the ask on a particular pair. So I hope that answers your question. You certainly, as you know, pretty much every Forex dealer out there competes on, trying to convince you that their demo account is awesome, or that their trading functionality and products are awesome. So they give you demo accounts. I would highly recommend you go check out a demo account with a dealer offering options and see for yourself, because you can get the prices very quickly. And which is another thing, by the way, if you're not really proficient at the options market yet or haven't had experience in it, you may want to check out that course, because we do talk about what's the difference between exchange traded options versus spot options, etc. So my time has actually come to a close, but what I wanted to be able to do was kind of get folks thinking about what are the ways in which they can, rather than waiting for a breakout to happen with an unexpected news event and then taking your trade, how can you take advantage of that opportunity before the unexpected event by trying to anticipate it? And one of the great things about using options is that it allows you to do that. And it's really not, although we use the example this time around of non-directional, it's really something that you can take advantage of as a directional trade as well. For example, going out a year in advance. So having an option that lasts for a year on the Aussie dollar, where you're anticipating that the dollar is going to continue to weaken, and the Aussie, let's say we think that the Aussie is going to go to $1.30. You could buy an option that allows you to do that for not a huge investment. It would be around 300 pips. But if the market did, in fact, go that direction, over a trend, over the last year, it went 1,300 pips. So the idea is, of course, to kind of set a trade that you cannot mess with, that has limited risk, or fixed risk is what I should say. Fixed risk, in which what you're trying to do is to take advantage of the unanticipatable, that event or trend that is very difficult to forecast. Okay, well, I've got 1 minute left. Anybody have any quick questions? Otherwise, I'll sign off. You are welcome to email me with questions that you have that you didn't feel like got answered. I would be happy to help you out. I have copies of the presentation if you'd like that. And then also this recording will be ready and available to anyone who would like it as well. So thanks, everybody. I really appreciated it. You can use, by the way, so trader, you're asking a question about leverage. Leverage is a little bit complicated in the options market. It is comparable to leverage that is available in the spot Forex. It's in your control. You can set your you have the flexibility to set leverage the way that you want it set. So I hope that answers your question. It's a little general, but you can investigate that a little bit more.